Sanjay Parekh is with us, founder and CIO of Sohum Asset Managers. Sanjay, good to have you with us here. Thank you for your time. Appreciate it. I mean, you're a bottom-up investor, and you're always on the lookout for interesting new ideas that you can add to your portfolio. And I see that you have, or maybe I'm mistaken, you've added a new name in the portfolio. Pondy Oxides and Chemicals, Sanjay. I think it's a new one. If it's not, please correct me and run us through what you're seeing here with this one.
Yeah, so this is into a similar business, of course, smaller in size, but similar to Gravita. The promoters have been there in this for long, 25 years. But now, in terms of meaningful critical size, it's still a micro-cap company. So you do have an execution risk, but here they are into lead recycling. And then now slowly they will also, of course, as a part of the process, you also recycle plastic. And then they will also move up into aluminum and other areas. We know the norms are getting more stringent for recycling. For battery manufacturers of the 1,000 batteries that they make, 550 have to be compulsory recycled. This will go to 850. So they have to see that if they sell to the dealer and dealer says to customer, they have somehow to get back 550 of the 1,000 they sell. So each of them, and it's certainly a supply chain business. I mean, you have to manage supply chain very, very well. And you source a lot of scrap also from overseas. So these are the companies who source it from 60, 70 countries and then recycle. And the risk management has to be very important because the output is lead or plastic, in this case, more lead. So you need to manage risk quite well. And the margins are not very high, but the asset turns are very high. So here is where we liked it. The market cap is 2,000 crores. It's a debt-free company. As I said, it's a micro-cap company which will do an EBIT of 100 crores this year, but has a potential to do more like, if they execute right, it could be 200 crores next year and then more like 300 crores. And if they get it, I mean, they are clearly expanding the capacity. So it has a potential to become like 450, 500 crore EBITDA company for FY28 and less financial risk. Execution is key, expanding capacities. They're setting up a new plant in Mundra as well, and also a continuous process plant. So we think that they have a right to win and it's reasonably valued. So we do look for such investments which are, and in mid and small cap, our return threshold is larger and this fit the bill quite well.
Any other purchases that you've done, Sanjay, in the last 1 month? Because you were sitting on a fair amount of cash, considering you were cautious on the market. And a quick word on EMS companies. They've all fallen 20% in the last couple of days, whether it's Syrma, Dixon, PG Electroplast. Any of them make it to your buy list?
Oh, they're still not cheap. We still find them expensive. And, we are GARP investors. Our portfolio price earning is 15 times. So on the way up, some of these we missed out. Of course, Syrma, we used to own it we bought it at 280, but we sold early in hindsight at 365. We were way early to buy it. But we didn't understand the valuation. And at our target price, we thought it was overvalued and we sold off. So we're following this opportunity very closely, but as yet we are yet not comfortable on valuation. In terms of new additions, we just added, after a very long time, HDFC Life, where we think if this, the regulations around the banking, the distribution through banking segment, if it's not capped, then I think it's very, very reasonable now. You take on any in the DCF value, embedded value plus the future value, it's very reasonable, a very safe bet. They've demonstrated their earnings growth also. It's a little tepid, but very, very well in control. After 2.5 years of underperformance, we think there is clear opportunity here. So that's what we have added. And we've just added a little bit of DLF. After this fall, we think while there could be near-term uncertainty because of the market fall, but it's a very classic play of a super premium segment if you want to participate. And they have all the land for the next 15 years. It's a debt-free company. They have a rental business. They have a core business of residential. And even in the standalone company, there's some rental piece which will grow. So we believe it's a safe bet again. And here they don't have to go to purchase land and do JDAs. They clearly have land for the 15 to 20 years, and they have a very, very premium segment, which they're just finishing camellias, and now they launched dahlias, which are at a super segment, super luxury at 1,20,000 per square feet. So I think it's a very large cash flow that they can generate. And hence we think it could be a good compounder from here, and we've added in a small way. But the cycle is important, and we need to watch if this market's being weaker is affecting the real estate cycle, which is a possibility.
Yeah, absolutely. And that, that's a word of caution, which is well taken. Stay on, Sanjay. We have more questions for you in just a bit. But since you brought up real estate, DLF, of course, is the stock that you like. That, DLF is a play and obviously the ultimate premium end of luxury. But is that a call you're restricting only to, say, the real estate space, or would you look to play that theme through other pockets of the market? Maybe, I don't know, jewelry stocks, or we don't have, super premium auto listed, so to speak. But is there any other way in which you'd play that?
Yeah, so we're watching each of them. Even Titan we're watching, but we're worried about this lab grown. And the youngster in our office clearly have preference for lab grown. So we are a little worried about, it's a great company and I'm sure they'll navigate it, but we're still watching this space if there could be any displacement or disruption by lab grown on the studded jewelry. So that is one piece that we're watching, but otherwise it's a great company.
What about something like, Indian hotels, again, talking about the premium end of hospitality?
Yeah, but it's a different business, right? In terms of almost it's like a treadmill where you have occupancy, and it's but Indian hotels, it's great, but we just saw it, and the valuations are really not now. They're quite rich, So that's where for us the price value gap that we see, and that we found at least even in real estate plays, this 40, 50, 60% premium to NAV. We are very, very uncomfortable, So we bought Century way early at 700, and then we sold off because we thought market is getting euphoric of giving a premium to NAV, which we just couldn't understand. But after this fall now, almost they are near to NAV or low. Some of them are now lower than a NAV, which makes sense now that you have a visible NAV. You, of course, would have assumptions around land bank and everything. But DLF we like because there's a real cash flow generation that they can do. In the DCCDL, there was 6,000 crore rent opportunity. They have very good understanding of the consumer. It's debt-free company. In the main parent company, their last year operating cash flow was 4,500 crores. This we think that in 3-4 years, and this is assuming cycle is steady, it doesn't go bad, which is what we think that, we're not going to go way down. If we think that is the possibility, then this could have a 7,000-8,000 crore operating cash flow for the parent. So such sort of cash flows in 3-4 years through the rental company and through the parent company, if they can generate over 3-4 years, this could be a meaningful compounder over next 3-4 years. That's the reason we have added, and that too I'm saying it's in a small way because we are worried about the cycle in the near term.
Just a broader question, Sanjay. When you look at the market and how prices have fallen, do you wish you had more cash to deploy? Or is the market...
Cash always, right? So, and all our investments in our fund, everything of our family. So it's always, in hindsight, you feel you had more cash, but today also we have 7% cash because we're getting inflows. But the good part is, this large cap buyers that we had, it does get vindicated that, at least on the volatility side, our portfolio is cyclical, so it is a little more volatile. It has less defensives, but then compared to some of the mid and small cap, it does help to have our strategy, and that's where we have indicated. And we genuinely believe from your, price-wise, we're done. I mean, you can never say never, but by and large, we think that price risk is gone. the expectations have to be tempered and we could have a back-ended return. But from here, 10 to 12% return is very, very likely for Indian markets. Now it's getting really comfortable to look into stocks in Nifty, a lot of them.
You own Aurobindo as well. You'd say that's the best placed pharma name? I mean, prices also come off sharply now.
Yeah, so of course you have the issue of perception of they're not generating the free cash flow over years. And it's a very valid argument. Now the capex is behind them. It's almost valued like a commodity. And historically it's been low. So that's been the case. So the change is that with the setup of this new Pondy plant, as they ramp up, and the capex is, let's say, in the next 2-3 years, what we hear from them is going to be tepid, ex-acquisitions, and I hope that's the case. And in that case, the free cash flow generation will be meaningful. And we've seen that earlier also, that even an expectation of free cash flow generation happens over future, the market takes note of it. And that is what we see even in Bharti that we added. As yet, the free cash flow generation is minimal. But the expectation of Bharti ability to generate free cash is what is giving the confidence, So this is what I think could change in Aurobindo, but we still have to watch, because if you see the last 7-8 years, because of the growth phase they were at towards acquisition and organic capex, they have really not generated free cash flow. So we have to watch whether they're able to generate 5,000 crore of free cash flow in 1 year. And if that is the case, we strongly feel that there could be a re-rating.
By the way, we're getting some more details on HDFC Bank. That's a 13% rise in slippages quarter on quarter that the bank has, showed up. And you can see a little bit of a tapering off of the stock from the top. I'm looking at the credit cost as well. Credit cost has moved up sequentially from 0.43% to 0.5%. So this is something the market will take note of. It's still stable. I mean, if you look at it year on year, it's not too bad. But just Q2 over Q3, there is a bit of an increase in the credit cost as well. Those are some of the internals that are coming in. But otherwise, on the margin front, they seem to be fine. They've managed about 3.4% net interest margin, which is more or less absolutely steady compared to last year. And it's a notch higher compared to the September quarter. Let's see how the stock performs right now. A little volatile. Sanjay, let's cap it off with your view on these large banks. And it's so different, right, for different lenders. We look at Kotak's reaction, that 10% massive move. There's HDFC where the market is being more measured. What would you do with the larger lenders? Would you buy anything now?
Yeah. So, we have all of them. You can see in our portfolio, we have HDFC Bank underweight. We don't have Kotak. We have ICICI Bank, we have Axis Bank, we have SBI. These are large exposures. So, clearly the growth has been tepid. 9 to 10% growth is good in this environment, and that's what we saw in Kotak. HDFC Bank also with 3% advances growth, 7% NII growth was expected. So we have to navigate. The CD ratio has to come down, and there's been explicit that this year will be equal to advance in the segment loan growth of the system, and next year will be higher. I am very confident in 27 would be a very good year for HDFC Bank, and in the current environment, even asset quality in terms of safety is better. They're better placed. So I think overall on valuation, they will underperform. But really for the lower growth also, now they're at very reasonable price to book. So I genuinely feel that this year should be better for banking in terms of stock appreciation, and particularly the larger banks.
Sanjay, great conversation. Thank you very much for joining in. Need to slip into a very short break, but look at the moves in some of the banks. IndusInd Bank has now surged 1.5%, and buying has emerged in Bajaj Finance and Finserv. Big moves in the last 10-15 minutes. Get into a break. On the other side, we'll get you a few BTST calls from our experts.